what is fundamental is to understand how compatible is the UK tax legal framework with the Spanish one, and specifically on two elements, which is one, death cover. So when moving to Spain, it is essential to have a death cover element on your policy, which market standard is now 1% of the premium or 1% of the surrender value, in order to guarantee that your policy, your offshore bond, has legal recognition. And the second element is investments. And on that angle, the UK and Spanish system are surprisingly very aligned.
You may want to also have simple wills in those jurisdictions. That will just make the probate process a whole lot simpler and quicker and save the estate money in the long term. And if he's going about doing things in that way, then a coordinated approach with advisors in each jurisdiction need to happen to remove the risk of one revoking the other or contradicting the other.
Today we're discussing the case study of a UK retiree moving to Spain with wealth held in a Luxembourg offshore bond. We're going to get into the details in a second, but first I'd like to come to my two guests for a brief introduction, starting with you, Stacy.
Thank you for having me. I am the head of the International Private Wealth team at Burdon, where I advise high net worth clients who are globally mobile on their tax and their residence planning, as well as their estate planning. I also advise them on offshore bonds and the UK taxation thereof.
Great to have you with us. And Gonzalo, welcome.
Hi, David. Pleasure to be here. So my name is Gonzalo Garcia. I'm heading the Wealth Planning and Product Solutions team in One Life Company, which is an insurance carrier in Luxembourg offering offshore bonds.
Fantastic. So we're going to look at the scenario here of James Thornton, who's a UK-domiciled retiree relocating to Spain with a £6.8 million Luxembourg offshore bond. Stacey, we're going to come to you first of all, looking at the UK exit tax and ongoing obligations. James is planning to leave the UK for Spain while holding a £6.8 million offshore bond with £3.6 million of unrealized gains. What are the UK tax implications the moment he ceases UK tax residency?
Well, the thing about it is there is no exit tax on offshore bonds or anything else in the UK. There's no deemed disposal or crystallization once he leaves. The main thing that James needs to understand is that he needs to make sure that he's planning his exit fully, completely, and he needs to keep an eye on his dates and his ties to the UK, because everything comes back to the statutory residence test in terms of taxation, and he does not want to come back into the UK before 5 years if he doesn't want the UK to sort of claw back on income tax on the bond.
So a lot depends on his lifestyle, really, and what he intends to, if he has got family in the UK and available accommodation here, there's a variety of things that could lead him into the UK.
Absolutely. It's not about a charge on exit. It's more about where are you going and how long are you going for? Are you planning to come back into the UK? If so, when? So these are the things that he needs to consider.
Thank you. And Gonzalo, so once Spanish resident, if James makes withdrawals from the bond, what happens to the UK taxing rights? How does the Spain taxation regime apply to the policy?
Yes, so for Spain, it's something to consider which is quite important. The notion of step up upon entry is not recognized, which means that any future withdrawals that that person may make on the offshore bond, any capital gains would be, one, taken as a reference the original premium value and not the value of the contract upon relocation. So that's very important. And the second element, of course, is that from a Spanish perspective, any withdrawal from a bond, it's categorized as a capital gain, not as an interest, not as a dividend. So at least from an internal perspective, Spain considers that it has the exclusive right of taxation and applies the taxation on that gain, and that gain being generated from inception of the policy. That has to be really taken into consideration, and there's no potential offsetting with foreign tax on this.
Okay, and Stacy, why is the concept of temporary non-residence important here from the UK side? Could James be caught if he returns within 5 years? What's the implication of that time horizon?
Yeah, absolutely. And that brings in sort of a double taxation question mark, right? Because if he leaves for Spain and then he returns before the 5 tax year mark, HMRC could claw back in terms of income on the bond and gains on other assets that he may have realised while he was in Spain. So the key for James is, if you're going to leave, make a clean break and don't return to the UK until after you've passed it, so 6 years.
And Gonzalo, what are the Spanish tax rates that would apply? We're saying Spain has the primary taxing right. How would it apply here once he's resident?
So in Spain, you have on income tax, you have basically the general progressive tax rates, which apply to employment income, pension, etc. And then there's the savings income tax rates, which are a bit lower. On there, the current marginal tax rate is 30%. It applies to all type of savings, interest, dividends, capital gains. So in case of redemption of bonds, any gain that may arise could be taxed up to 30%, together with the other investments and passive income that person may hold at that time, together with the offshore bond.
And in terms of terminology, Modelo 720 is an important concept that people might have seen. A Spanish overseas asset reporting requirement. Does James's bond need to be declared? What are the penalties of non-compliance? What's the impact of this?
So despite that form, so Modelo 720 is basically a form where you declare to the local authorities the existence of assets abroad. Okay, for instance, for bank accounts, it's anything above 50,000 euros, but you need to declare, in principle, the existence of a policy or offshore bond issued by a foreign insurance company. That's an obligation. It has been under challenge, but the obligation is still there. In the past, the penalties were quite harsh. Now they have been reduced and they have been more understanding on this, but the obligation still exists. And despite that being a bit of nonsense in the current context of CRS and exchange of information, the obligation still exists. However, it is important to say that in the case of foreign insurers acting in Spain and fully regulated, that obligation does not exist anymore for those clients, Spanish residents, because the insurance company is doing that on behalf of those clients, meaning the carrier is reporting the value of those policies, of those bonds, directly to the Spanish tax authorities. So therefore, there is not a risk of non-compliance by the Spanish resident bondholder anymore.
And how do you contrast the Spanish tax rates with UK tax rates? James is familiar with the way the policy's taxed in the UK. How would you describe it in the Spanish tax treatment?
Yes, I would say that I would tend to conclude that overall the UK tax treatment is slightly more beneficial, because the 5% annual allowance is a huge benefit if compared to Spain, where no allowance exists. So all gains that you may generate are taxable at those rates. So in the long run, and if you plan correctly, I think the UK tax treatment is more beneficial than the Spanish tax. In the long run, the UK tax treatment is more beneficial than the Spanish tax treatment for offshore bonds.
But I suppose it's about looking at James's broader scenario, because we know he's a retiree. If his marginal rate in Spain might not be so significant, if he's going to rely on this for his main kind of pension income, if you like. So it always depends on circumstances, doesn't it?
That's fully correct, yes.
Spain has a wealth tax. So how does this policy interact with wealth tax in Spain?
So wealth tax has always been a complex issue in Spain because, as you know, Spain is a quite decentralized country. So wealth tax highly depending on the region you were living in. For instance, typically in Madrid or Andalusia, where many clients go, that wealth tax was factually exempted, while it applied in other regions like Catalonia or Valencia, for instance, right? So 3 years ago, there was a full harmonization at state level, which imposed the wealth tax for any taxable basis above 3 million, which means that in practice, even if you live in regions where wealth tax was exempted, now for clients above with wealth, globally speaking, not only in Spain, above 3 million, they will be cut anyway by that tax. And that applies as well to the value of the policy, which should be declared in the wealth tax form. And people should be paying wealth tax on this as well, yes.
So when James changes his tax residency from the UK to Spain, does he need to notify One Life as a life company? What's the steps there?
Yes, indeed. So we have a specific system of documentation that enables portability. So every time a client notifies a change of residency, that has impacts potentially at reporting level, at product level. So we have to be quite diligent about this. So we provide the clients with a specific form about what are the necessary changes. Of course, everything is put in the system, updated with the new tax residence. And of course, it has reporting obligations such as CRS. So it is very important to manage this process very well.
And One Life can continue to look after him after he's Spanish resident because of your pan-European offering. What are the restrictions that would apply, or where might this go wrong if a client's moving from the UK to Spain with a policy?
Yes, so from an administrative perspective and communication perspective, of course, everything would still work as before, so no issue at all, as I said. And then what is fundamental is to understand how compatible is the UK tax legal framework with the Spanish one, and specifically on two elements, which is one, death cover. So when moving to Spain, it is essential to have a death cover element on your policy, which market standard is now 1% of the premium or 1% of the surrender value, in order to guarantee that your policy, your offshore bond, has legal recognition. And the second element is investments. And on that angle, the UK and Spanish system are surprisingly very aligned, because Spain is very aligned with the HRMC guidelines, as you have two main options, which is funds, UCITS funds, which at the end they are collective investment schemes, so that's a very compatible option. And second, managed account model portfolios with no personalized strategies and no personalized assets. So in that space, both systems are very compatible. So normally when you have clients moving, they already have an investment option which is very compatible with Spain when they're coming from the UK.
So it's likely to be a fairly seamless transition in the case of UK and Spain?
That's fully correct, yes.
And what if James was considering moving to Portugal if the Spanish environment is less favourable, or they just prefer the idea of moving somewhere else? On a subsequent move, what happens there?
So Portugal is way more flexible than the UK or Spain. For instance, it does not require to have a death cover implemented. It allows for advisory accounts. So normally when you have clients moving, that will never be an issue, and you will even be able to provide those clients with additional features that they did not have before. This does not exclude the fact that this client, of course, needs to tell you that he's changing his tax residency to comply with the appropriate regulatory and reporting obligations. But besides this, that move as well, it's fairly easy, and both for the insurance company and for the clients.
So just looking at the multi-jurisdictional estate planning here, James is UK domicile, is going to Spain, may move to Portugal in the future. Gonzalo, I mean, how would you start thinking about estate planning for an offshore bond given these three jurisdictions in play? So
first you need to think, do these three jurisdictions recognize the bond? Yes. First, what is my nationality, and what will be the succession or inheritance law that will apply to me? Because depending on the country, there's a big distinction between civil and common law jurisdictions, in the sense that typically in the UK, the rights of the bond go to the state. So there's a specific process, while in the continent we use and we just follow strictly the beneficiary clauses. So you need to understand how is your patrimony be governed, by which law you're going to follow, whether it's the UK one or there's going to be the law of your new residence, and then will be certainly established by where you have established your will and which law you've chosen. So that's fundamental to understand after what are going to be the consequences in your bond while you die, and who is going to receive the benefits in one way or another, and the potential tax consequences, whether your beneficiaries or your children have stayed in the UK or whether they are moving to you, and understand what are the consequences for them as well when receiving the benefits from the policy. So that you need to understand fully. You need to have the full image before having a full assessment of the situation.
Thank you. And Stacy, I mean, we don't know the full picture here, but if James has family members staying in the UK, assets there, how would you approach the estate planning side? The bond is one aspect, but the bigger picture, what are some of the things that he should be considering?
Well, one of the things would be under Brussels 4, James would be able to elect, as a national of the UK, he would be able to elect British law, essentially, to govern his estate and the succession thereof. So that would be one thing that he may want to consider, considering parts of the continent have forced heirship rules in terms of how assets are, how they devolve towards beneficiaries. So if James wants absolute testamentary freedom, then he should probably draw up an English will and elect that English law governs his estate on his death. If he's got immovable property in Portugal or Spain, then he may want to also have simple wills in those jurisdictions. That would just make the probate process a whole lot simpler and quicker and save the estate money in the long term. And if he's going about doing things in that way, then a coordinated approach with advisors in each jurisdiction need to happen to remove the risk of one revoking the other or contradicting the other. So I think that's one thing from a succession point of view. From an inheritance tax point of view, James sounds like he was a long-term resident in the UK. So he's leaving and he may think, oh, inheritance tax, no more. But now we've got an IHG tail as of 6th of April 2025. So his estate may still very well be in the UK inheritance tax net. And that's something that he would need to receive advice on.
And these policies can be owned through trust or corporate structures. But what are the limitations or opportunities around owning a policy through a trust for a UK?
Yeah, no, I think the thing about trusts or corporations is that it's like no one rule. You know, it's not a one size fits all, and I don't really necessarily believe in structuring for structuring's sake. I think the main thing that James needs to consider is how he wants the bond to, who he wants the bond to benefit. Whether he wants to, for instance, make the probate process a lot swifter, whether he wants the bond to come out of his estate. A trust can absolutely help with that, as well as asset protection and ease of succession. However, in some civil law countries, trusts complicate things. So it's not, that's why I say it's not a one size fits all. It's something that's very bespoke, and I don't believe that you should structure it for structuring its sake. You need to look at both jurisdictions and consider, you know, what's actually going to ease the process and be most efficient.
And Gonzalo, in terms of the bond being denominated in euros, James has always been a sterling investor with sterling assets and income. How do currency considerations play out here?
Yeah, so that could be combined. So of course the policy as such, the contract could be denominated in several currencies, including of course euro and GBP, no problem, and the same could be kept even while changing residency. So there's no need to change currencies during the life of the policy. And of course, the accounts beneath the policy, so the investments as such, or the portfolio accounts could be denominated as well in different currencies. So when making transactions, we can make the transaction in the currency of the portfolio account or in the currency of the contract, depending on the wish of the client. That's fully flexible as a.
And just coming with some concluding thoughts, I mean, what's your key piece of advice to clients undertaking this move or professionals working around them? What's the one thing you'd want to table with them on a cross-border move?
So I would say if you plan to move, first think it about minimum 3 to 6 months in advance. Are you planning to move alone? Are you planning to move with your family? Where are your assets? And inform yourself about what are going to be the tax consequences upon relocation in the original jurisdiction, and what's going to be the tax regime in the new jurisdiction applicable to your financial products and assets, and especially if possibly you could still benefit from some preferential tax regimes that you have in some European countries, and you have the chance to apply to them before it's too late, so that you can have some tax reductions or some safe tax haven during some years. You could benefit if you fulfill some conditions, and that's clients maybe, if you do it too late, maybe that you may be too late to benefit from this. So all these things need to be carefully thought before relocation.
And looking forward into the future with these jurisdictions we mentioned, the UK, Spain and Portugal, are there any developments that people should be aware of or thinking about or might see coming down the line?
Yes, so I would say especially for Spain, as we have said before, there was a harmonization process for wealth tax, so that's already happened. And now there's a strong tendency to have the same for inheritance and gift tax. Right? As you know, in some regions, between regions you have no strong disparities, and there could be bad surprises in some of them suddenly having a huge tax hikes due to the state intervention. A lot of the wealthy clients live in specific places where currently effective there is no taxation on inheritance and gift tax between relatives. That could suddenly change, and that's going to likely come. And clients should be aware of this.
And Stacey, are there any upcoming developments in the UK that people should be aware of?
I think anyone planning around the UK should treat the UK tax landscape as a fluid situation. So build in flexibility in your structures and in your plans. Don't focus on one specific rule changing. Just look at the direction of travel, of where things are going, and not just in the UK, but in other jurisdictions that are relevant to your planning. Specifically, the statutory residence test, now that domicile is no longer the anchor for taxation, but residence is, there are a lot of people who are, yes, exiting the UK with a clean break, but equally there are a lot of people who are looking at the rules of the statutory residence test, not selling up in the UK and going back and forth. So this could potentially be a source of inquiry for HMRC down the road. So keep records. Always keep your records of your days, your ties, your movement between the UK and other jurisdictions.
If you were having a meeting with James, what's the top thing you'd want to table with him to start discussing?
That he needs to take advice from his departing and arriving jurisdictions well in advance. So I agree with what Gonzalo was saying, that part of the main issue is that planning is left too late, and you can't make a move with these assets or any assets if you're making a cross-border move in isolation. So you must contact and liaise with your arriving jurisdiction and your departing jurisdiction to make sure that you are not inadvertently creating a liability for yourself, rather than, the relocation in itself can be a good thing, but it can also create problems if you're not sufficiently planned.
Well, sound advice there for anyone watching this. Thank you so much for talking to me today, and we look forward to sharing this case study.
Thank you.
Thank you.